right, time to circle back to the insurance space. This group spent most of the 2018, say, in the doghouse because P&C, or property and casualty insurance companies, are levered to interest rates. Remember how the industry works. Insurers don't just take your premiums and then lock that money up in a vault. They invest it, which means when rates are rising, they can generate a better risk-free return. That means the insurance stocks did go out of style when the yield on the benchmark 10-year Treasury started falling early this year. But now that yield on the 10-year is climbing again, the group has gotten a whole new lease on life. Plus, pricing had been very competitive here. It now seems to have gotten less cutthroat. Take Chubb Limited, the insurance company created by the merger of the old Chubb with Ace Limited back in 2016. At the end of June, the stock was down 13% for the year. Since then, it's rallied more than 10% just in July alone. Oh, and last week, Chubb reported a darn good quarter, a nice earnings beat driven by, and I quote, excellent underwriting and investment results. So can Chubb keep climbing here? Even after its latest move, the stock remains down roughly 4% for the year, which means it's got some catching up to do. Let's check in with Evan Greenberg, the chairman and CEO of Chubb Limited, hear more about the quarter and where the company is headed. Mr. Greenberg, welcome back to Mad Money. Good to see you, sir.
Jim, good to see you.
Yeah. Now, I have to tell you, I know that rates are important but for your company, but I see every single line, with the exception of just small niggling things, you got price. Every single line. This got to just fall right to the bottom line.
Well, you know, some of it falls to the bottom line, but remember, loss costs rise every year. You have a certain amount of inflation, whether it's on property related or it's casualty related. So just to stand in place, you have to get rate.
But you are generating a lot of cash, and I know these analysts are all trying to figure out whether you're going to do another big deal. It sounds like you want to use the cash to be able to expand around the world, and that's a pretty good business.
We have operations in 54 countries around the world, and if you look at this quarter, which I think is evidence of our future, we're firing on all cylinders. Asia, Latin America, the U.S., we've had growth in our commercial business, in our consumer-oriented businesses, and I just see that momentum building in the company.
Okay, so for the non-cognizant, for our audience, you say in North America, for example, rates overall were up 3% versus 1.9% last quarter. That's actually a monumental amount of money for you, isn't it?
Well, I don't think it's monumental. When you imagine that loss costs are rising anywhere between 4% and 6%. So, you know, that's you're still not keeping pace with loss costs, but it's better than it has been.
Okay.
And by the way, for the last number of years, rates have been going down.
Right, that's what I'm looking at an inflection point.
Well, that's the point. And so rates have been going down on one hand, and on the other hand, you have inflation. So, you know, you do need price increase to maintain a healthy, risk-adjusted return.
I think a lot of our viewers think, look, I haven't had anything go up in value. Where is the inflation in the system that you see?
Well, it's on the liability side. Imagine mergers and acquisitions, liability, directors and officers liability. Almost every single merger or acquisition has a shareholder suit. And by the way, most of them, around 80% of them, no money goes to the shareholders. It goes to the trial bar. Now you have inflation there. Most liability, you see the loss costs rising. And then, by the way, in property, whether it's the cost of repairs, the cost of parts, the cost of labor, of materials, costs are rising.
Okay, now one thing that you're doing both to combat costs and also because you've been the visionary in the industry. You're finally getting digitized. It seemed like the industry itself was just ledgers. What does it mean? Because you emphasize what it means to spend that money on digital.
You know, we spend over $1 billion a year on technology. And let's imagine this. I see it differently. We're in a world that's going from analog to digital. Everything is. If you remain analog, you're history. So, of course, you're going to digitize. People want anytime, anywhere service. The notion of the product we provide, which is about repairing it or replacing it, it's going to move towards predict and prevent, which is about using data and using Internet of Things, IoT. And then imagine our ability to service you in claims and in underwriting. Right now, if you're a small business, to underwrite you, we ask you about 30 questions. For Chubb, over the next 18 months, that'll come down to about 7 questions, because we can just scrape the answers from data that is publicly available. Don't need to bother you with that. Eventually, going to have to ask you 2 questions. What's your name? What's your address? And we'll be able to figure out the rest of underwriting.
Well, in full disclosure, I've been a Chubb customer for close to 30 years, and I only get to ask those questions now, and it's not favoritism. You just have my complete record. But I want to congratulate you. I think this is the inflection, and Chubb is the best in the industry. Thank you so much.
Jim, thanks so much.
Absolutely.
Great seeing you, my friend.
Okay, that's Evan Greenberg, Chairman and CEO of Chubb CB. The rates are going higher. The opportunities to invest are getting better. And digitization is going to save them a fortune. Mad Money's back after the break.